Vedanta's share has surged nearly 11% in 2 days on hopes that the big restructuring plans announced on Friday will unlock shareholder value. However, the optimism over the six-way demerger is tempered by the parent company's debt scenario. The company has to pay back nearly $4.5 billion in the next 18 months.
A decade ago, Anil Agarwal embarked on a mega consolidation at his group's metals to crude India business under Vedanta Limited to drive valuations. He now plans to undo much of that again to unlock value amid debt woes. On the evening of 29 September, the 69-year-old Agarwal's operating company, Vedanta, received approval from its board of directors for a major reorganization into 6 separate listed independent companies. These companies are Vedanta Aluminium, Vedanta Oil and Gas, Vedanta Power, Vedanta Steel and Ferrous Materials, Vedanta Base Metals and Vedanta Limited. Shareholders of Vedanta will now get 1 share in each of the 5 new listed companies for every 1 share held in Vedanta Limited through a simple vertical split. There will not be a fresh public offer and hence no cash infusion into the group. Volcan Investments, the ultimate promoter entity of Vedanta and the investment holding vehicle for major shareholder Anil Agarwal, will be renamed as Vedanta Incorporated. After the reorganization, it will be the sole or majority owner of 17 investment vehicles. However, troubles are far from over for Anil Agarwal. Analysts feel the massive reorganization exercise does not address Vedanta's debt obligations and that the consolidated debt across all its proposed entities still remain the same. Vedanta Resources has outstanding dues of $6.4 billion. Of this, it has to repay around $1.4 billion in the next 6 months. Around $3 billion plus interest has to be paid by March 2025. There are reports that Vedanta could sell its Demerger steel subsidiary by March to reduce the group debt. Though the company claims that it has a repayment plan in place, most analysts have maintained their sell rating on the stock, casting doubt on its funding gap and a lack of focus on core operations. Bureau Report, Business Today Television.
Earlier in the day, I also spoke to Avinash Gorakshakar, Director Research at Profit Mart Securities, to find out whether Anil Agarwal's strategic move to demerge Vedanta will help him really clear the impending $4 billion debt obligation and whether the move can truly unlock value for shareholders. Vedanta is clearly the talk of the town as far as the markets are concerned. Help us understand first up your view of how you analyzed the news of this 6-way split that the company is going to be doing, and do you really feel this is going to be good news for Vedanta the company and also good news for Vedanta the shareholders? How would you analyze this?
No, I think, Sakshi, the Vedanta demerger actually has come as a very big surprise to the markets because, see, clearly earlier Mr. Anil Agarwal was focusing on the consolidated entity, and now they have decided to split the entire company into 6 different entities. Vedanta, will be the holding company. They will have control over Balco as well as Hindustan Zinc. So typically, holding companies don't get a significant premium. They trade at a discount to the market. But as far as the others, companies are concerned, I believe the investors, the shareholders would now get an opportunity to participate in these companies, in a very focused manner. And typically, market loves, companies which have got focused businesses. So the earlier model was of a consolidated entity. But the real reason for the demerger, according to me, is the fact that, there's a large amount of debt repayment which the company has to make by FY25. And I think on a consolidated basis, actually, it would have been very difficult. So I think the demerger is just a proposal to ensure that the debt repayment gets paid fast. So my sense is, there are going to be many ifs and buts. The demerger, first of all, has to be approved by the institutional shareholders. And most importantly, we are not aware how the debt is going to be distributed amongst all the companies. So I think it's going to be a little wait and watch before one actually comes at a clear view on the overall demerger which has been announced.
Well, markets closed in the red today amid negative global cues and renewed concerns over inflation. Almost all the sectors traded lower, with heavyweights like IT and finance along with autos and energy shedding some weight too. Sensex dropped 316 points and settled the day at 65,512, and the Nifty closed 110 points lower in trade to settle the day at 90,529 levels. The top Nifty gainers were Bajaj Finance, L&T, Titan, Bajaj Finserv and Adani Ports, while the top laggards included names such as ONGC, Eicher Motors, Maruti Suzuki, Hindalco and Dr. Reddy's. The World Bank has kept India's growth forecast unchanged at 6.3% for the current fiscal year. The Multilateral Development Bank has today, in its India Development Update, given a thumbs up to the service sector, saying it will remain strong with the growth at 7.4%. The World Bank also added that investment growth will also remain robust at 8.9% despite global headwinds. The report states that India continues to show resilience in the face of a challenging global environment, including slower than expected global growth, higher oil prices and persistent inflationary pressures. It, however, warns that food prices will remain high and will keep inflation elevated at 5.9%, which is just 10 basis points lower than the upper limit of the RBI's tolerance level.
The sort of main policy priority, the most urgent one across the region, is to really manage and reduce fiscal risks. That is one of the critical sources of vulnerabilities around the region. In the longer run, it's about creating growth. The challenge is about creating growth, creating jobs. And there, private investment is really the weak spot. Around the region, it's the weak spot. And that needs many things to go right to improve private investment. Business climates have to be right, financial systems have to be strong, you need public investment. And it helps if you have less restrictive relations with the outside world, fewer trade restrictions, fewer capital account restrictions.
And as markets continue to decline along with rising inflation, the question of where to stay invested in this volatility has always troubled new investors. Business Today television's Tanya Aneja also spoke to Kalpen Parekh, the MD and CEO of DSP Mutual Funds, about the investment strategy for investors and where the Indian market stands, especially after JP Morgan announced its decision to add Indian bonds to the emerging markets.
Let me begin by asking you firstly, about the Indian markets only. I mean, the markets have had a stellar run. We did hit 20K as well. But right now, if you see, the markets are volatile. Whether it's the rise in crude oil prices, then the expensive valuations, and then hawkish US Fed commentary as well. And lots happening also, sir. If you see, this inclusion of India in JP Morgan EM bond index, and then Nomura also upgraded India to overweight from neutral stance. So I want to know it from you that, how are you approaching markets at this point in time, and what should be the strategy for the investors?
Firstly, thanks for, talking to us at DSP. As you rightly said, many things are happening and they're all not happening in the same direction.
Right.
So on one hand, oil prices are rising and inflation is going up, and interest rates are also rising in different parts of the world.
Right.
On the other hand, there are positive developments after a long, period of conversation between India and the rest of the world to have our bond index, bonds getting included in the bond index. So that also in a way indicates that the world is looking for stable places for allocating their long-term capital. So I always think about it this way, that when the world is wanting to invest its long-term money in India,
Right.
we as Indian investors should also continue with our habits of long-term investing and build our long-term portfolios. And any investment decision, according to me, should not be a function only of how our market's looking, but should be a function of what is our objective from our investments.
Okay.
So if our objective is to park money temporarily for just the next 3 months, then anyways markets don't matter, because then you have to invest in money market funds or let it be in liquid funds or arbitrage funds. And if our horizon is to build a better future by investing for our retirement or for a lot of our goals 10, 15, 20 years down the line, then again anyways today's markets will not matter, keeping the next 10, 20, 30 years in mind. So I feel markets have always been volatile. It's nothing new.
Right.
Which is why, at DSP, we have a very firm belief. In fact, a few years back, we did a very honest ad campaign. I feel that in my entire career, that was one of the campaigns that I related the most with. where we had a hoarding campaign which just said markets fluctuate. Because that's the inherent reality and truth of market every day, every quarter, every cycle. Something or the other will fluctuate in opposite directions. So in our view, markets have been reasonably confident and positive over the last 3 years after COVID. Prices have rewarded bold investors who had the courage to invest when data at that point in time looked very bleak, when last 1 or 2 or 3 year returns looked very poor or negative. There was a lot of uncertainty about how the world will look like in the next 1, 2 or 3 years, but investors who said that, okay, I have to build long-term portfolios, and hence if markets are giving me lower NAVs and lower prices for good companies, let me build my portfolio. So those investors have been rewarded.
And Maruti Suzuki has surpassed the million mark for a half-yearly sales for the first time this fiscal year. India's largest automaker, which has become the SUV leader in July, also expects this festive season to be a bumper one for the industry. However, as the company's senior executive officer, Shashank Srivastav, tells Business Today Television's Chetan Bhutani, demand in the entry-level car segment remains muted.
It has seen the highest ever quarter in the passenger vehicle. 4,59,000 was the number in Q2. This is the highest ever quarter for Maruti Suzuki. Also for H1, which is the period April to September, overall Maruti Suzuki sold 10,50,000 vehicles. The first time it has crossed the 1 million mark in a half of the year. That's also the highest ever. So in that sense of overall volumes has been great. But yes, because of a large base of last year, this quarter you would have seen, not just for Maruti Suzuki, for the industry as well. In fact, Chetan, for the industry, the number in September, highest ever in any month of any year in our history, 3,63,733, but the growth is only 2.3%.
But are you really looking at a strategy to reduce the numbers of vehicles being manufactured?
So in this quarter, we have, yes, you're right, because remember, because of the semiconductor supply constraint, we were not able to produce many of the other vehicles for which we had long pending bookings. And in fact, the number of bookings were very large. And we have, thankfully, in this quarter, that is from July onwards, we have seen much better situation as far as that is concerned. And we have been able to modulate our production for the small cars and been able to make the larger the SUVs, some of the other vehicles which had long waiting period, including the Desire and the Brezza, which we have been able to make now. And that is how our waiting periods have come down for those other models. And also that the inventory is coming under control for the dealers for the small cars as well.
All right. Also, sir, if I look at the exports, last month exports were a bit flat. How are they looking now?
Yeah, so exports actually good numbers, 22,000 plus against 21,500, I think, of the previous year. Flat, you are right. This H1 has been like similar numbers, 132,000, which was similar to the last year number. Last year we had a record exports, 259,000. We are still maintaining that we're going to cross that number by the end of this financial year.
Any more SUVs being planned after Invicto? How's the response been there? And do we see any new SUV coming up kind of as a fresh surprise during the main festive season now?
Not in this main festive season, but I must tell you that Maruti Suzuki has always, gone with consumer choices, always have enhanced our portfolio. You saw that in the last few months. We have introduced the new Brezza, the Vitara, of course, and the Fronx, the Jimny, and the Invicto. And that's one of the reasons why we have been able to become the number 1 manufacturer of SUV in this H1. In fact, we were number 4 last year with 12% share. Our share this quarter has been almost 24.5%, 25%. And that's why we are number 1 manufacturer in the country today. And going forward, I think we need to get a more market share in the SUV segment if we have to achieve our 50% market share, because now SUV is 50% of the market. And in the non-SUV, we have a 65% market share.